I'm Erin Abrahamson. I'm the Chief of Staff here at the National Center, and I'm introducing our next speaker, and it's going to have a focus on export. And so I don't know if anybody of you know, but the National Center actually opened up a export center that is funded by the NBDA. We're into our second year of that. And so in the past year, we've really put a focus on exporting. Our next speaker is Jim Newton, and he's the Export Finance Manager for the Office of International Trade, SBA.
Yeah, maybe your microphone, is it right there? There you go.
We're live. Jim Newton. I'm with SBA's Office of International Trade, which, as Anna pointed out, is a subset of the 7A programs. We have 3 programs that are dedicated specifically to export financing for small business. And I have the very good fortune of being the export finance manager for a territory that covers Oregon, Southwest Washington, which is primarily Vancouver, Southern Idaho, Northern Nevada, I get all the halves, and Hawaii, Guam, and the Commonwealth of the Northern Mariana Islands. So I have a lot of water to cover. Unfortunately, I may not make it there in this fiscal year, but I hope to. And with that, I'm going to lead off with a somewhat more detailed or in-the-weeds presentation of our programs to try and give you as much familiarity with what we can do to help you export products and services. And let me first explain. Let me see if I can get this to go. And here we go. Now, the first thing I want to do is establish what is exporting from SBA's perspective. And we have just recently reinterpreted what exporting means, because we now state under our SOP, an export transaction is the production and payment associated with the sale of goods or services to a foreign buyer. I'm going to come back to that in just a minute. Other guidelines that apply to companies that want to utilize our guarantee programs for export purposes include all of the general 7A rules. Again, we're a subset of 7A. And the applicant, or therefore, I should say, the applicant must be located and primarily operate in the United States. That's kind of a given. We're here to help develop employment bases across the U.S. through our guarantee programs. We're an economic development agency any way you cut it. And the loan proceeds must be used exclusively for the benefit of the domestic operations of that business. And finally, the businesses are eligible only if the business is at least 51% owned by U.S. citizens or those with lawful permanent resident status here in the U.S. So as long as all those 3 apply in addition to the definition, then a small business in the U.S. can utilize our export guarantees to sell product or export product from the U.S. to all the foreign countries, and it actually can sell goods from another foreign country to a foreign buyer in another foreign country. It also allows for international tourism as an export, because as long as we're defining exports as sale to a foreign buyer, that foreign buyer can come to the U.S. to be able to acquire those goods and services, literally take them back with them. So that's our starting point. And then we also have a definition around indirect exporting, which is to say you are selling to another U.S. company that is on exporting the goods you sell them. Most cases, it's going to be incorporated into a final product. So yours is a component of their final product. And a great example is, of course, Boeing and the supply chain that supports Boeing throughout Washington State and Oregon and in the general Northwest and beyond. And all those suppliers are eligible on the simple fact that 73% of Boeing's aircraft sales go overseas. So we can almost automatically qualify those suppliers to Boeing, and we have done so. But it can also be done as far as a smaller firm that you might be selling to that's, again, on-selling your product as part of theirs, or even just as an export trading company selling your product overseas. That can be done on the basis of documentation from that end exporter. And then finally, there is a provision under the international trade loan specifically that allows for the use of our guarantee program due to adverse effects of foreign competition. So to the extent that your business were impaired or you suffered an economic decline or loss of sales due to foreign competition of products or services, then we can make our guarantee available. It does require a fairly good amount of documentation to establish the adverse effect, but it can be done. Not often. These are the three programs that we provide under the Office of International Trade. The International Trade Loan Program, which looks a lot like the conventional 7A term loan, but is for companies that are exporting or would like to export. And I'll come back to that because it's a key element of this program.
I think we have one question.
Sure.
Jim, thank you.
Yeah, and I do want to open it up so it's a discussion, not just me up here talking.
Can you go to the last slide? I was
Sure.
wondering if there's been a case of Native-owned business being eligible based on that adversely affected import competition based on Native-inspired goods versus Native-made goods. Have you seen that before?
I have not. I'm sorry to say, but you say it's being done by a foreign competitor by chance?
I think we see a lot of Native goods that have designs that are stolen, replicated, sold, created.
Yeah, that's going on throughout the world in all areas. But
and hearing that there's a significant amount of work that has to be done to demonstrate that. I'm curious if that work has been done from another company, or if that's something that the SBA has been aware of and has seen some other companies potentially access that.
That is, it's a very good question, and I will have to look into it to find out if we have a precedent of that nature. I concede that this particular aspect of the program hasn't been utilized that much for a fairly good while, but this is potentially an area. In fact, Sam Goldstein, who is the gentleman that is the deputy director for the Portland District Office, really great guy, and who really gets into it. I will pursue this with him to see if by chance he is aware of it as well. Thank you for your question. And I do want to encourage you all to go ahead and pose questions as we go forward here. So the International Trade Loan Program, leading off there, average size a little over $2 million historically. It's a term loan financing for up to $5 million. It carries a 90% guarantee for the full amount. In fact, the international programs in general have a higher guarantee percentage than the rest of the 7A SBA guarantees. And it's simply because Congress recognized, the administrations have recognized that we've got to encourage U.S. lenders, bank and non-bank lenders, to be more active in providing working capital to small business exporters in this country. They are averse to doing that. I can safely say that. It's my job, my reason to be out there encouraging those lenders to make that working capital available, utilizing our guarantees. Actually, with or without, but primarily utilizing our guarantees. The Export Express program is what I refer to as the Swiss Army knife of export finance because it is the most flexible and I'll say most easily used program and usually has quicker turnaround times. I'll discuss that a little further in that section on that particular program. But in this case, average size historically a little over 264,000. It goes up to 500,000, and it's the one program that we have a stair-step guarantee of 90% up to 350,000, 75% from 350 to 500. And this program, along with the SBA Express program, both benefit immensely from the waiver of the SBA fees for loans up to 500,000 because they're both limited to 500,000. So basically, no fees for the Express programs. Export Working Capital Program, in my opinion, that is our greatest value added. We actually get involved in doing the underwriting alongside the bank for these transactions to, in a sense, help the lender as needed. Some are very sophisticated and certainly can structure it well on their own part, and we're always involved in discussing these transactions with them before they actually go to their final approval. But we do add our comments after they have, our comments and our recommendations after they have approved their facility. In this case, again, coincidentally, it happens to be a little over $2 million as an average loan size, asset-based line of credit up to $500,000. It actually can be done under purchase order style financing as well. I'll come back to that in a little bit more detail. And then you can issue standby letters of credit under this program, actually under Export Express as well. It applies a little bit better under the EWCP, and you only have to post 25% collateral support to utilize that standby. Great cost savings. International Trade Loan Program, I'll start off with. Again, 90% guarantee up to $5 million, term loan only, very similar to standard 7A, mortgage style amortization. And all loans require an export business plan. That's kind of a basic principle. It's usually used for real estate and equipment purchases, as well as permanent working capital for up to 10 years. And it can be any purpose that leads to an increase in export sales or export markets, or an increase in export sales or in export markets in terms of expanding your base and that it improves the firm's competitive position internationally. We did add this feature in the past fiscal year where you can actually use the International Trade Loan Program for stock or asset purchases. There are some restrictions as opposed to conventional 7A, which is much more liberal. But in our case, no partial or intercompany transfers. Buyer must be otherwise ITL eligible based on its exporting capacity. Acquisition must include the purchase of facilities or equipment to be used in exporting, and acquisitions of businesses for their intellectual property are permitted only if there are assets purchased as well. Collateral-wise, no, this is an interesting topic there a while ago as far as how this would not apply on Indian land, but as far as the international trade loan is concerned, or any of our export loans, there is going to be a lien requirement under conventional UCC guidelines as the lenders are going to require, and we require it of them. But all ITL loans require first lien on the assets being financed, though you can request a second lien position. You can't do it under delegated authority as far as the lenders are concerned, but it can be done under general processing, which means it goes through our Loan Guarantee Processing Center down in Citrus Heights, California, for their review and final decision. Other collateral might be required in that scenario on a second lien. No lien less than a second. ITL eligibility, the applicant must establish that the ITL proceeds will expand existing export markets or develop new ones. And that, therefore, is the mantra for the ITL, is ITL loan must lead to increased exports. or shall I say, is intended to. Nothing is an absolute requirement in the sense that you'll be docked for not having accomplished that, but that needs to be the intent. Applicant details how the loan will increase exports in their export business plan, and then the lender will turn around and use that information to document how the ITL loan will improve exports and their competitive position in their credit memo, which we ultimately receive. ITL loans can support new to export, e-commerce, modest to significant growth in export sales. In other words, it doesn't have to be a giant leap in that company's exports. It can be a gradual thing. And the new to export is where the business plan becomes really critical. As far as an overview of putting together the export business plan, it is the most critical component, as I mentioned a while ago, in terms of eligibility for this program. And there is no mandatory format or required length. The export business plan needs to be comprehensive, and it must tie the loan proceeds to an increase in export sales. Again, showing what is intended. For active exporters, it should include a discussion of current export markets, distribution agreements, and historical export sales performance. And then for new early stage exporters, these are the folks that are sort of planning to build their export business or are just getting started, should include an explanation of target markets, a review of export competition, market entry strategies, including any trade barriers, and required product modifications, and pending or signed distribution agreements and export orders. This is just an indication of what I call the ITL checklist and putting together the export plan. I think you can read it okay. It's large enough. Nature of the export activity, as whether it is a direct export or an indirect export, as I was explaining a moment ago, the description of the borrower's product or service to be exported, and then very, very important, estimated direct or indirect export sales for the next 12 months, sort of guesstimating from the planned date of the closing, and then also actual indirect or direct export sales for the past 12 months. The export experience of the borrower, export markets that you're going to be selling to. There are some actual constraints on that. Yes, sir.
I was just wondering in my head, and then I did see on the form, maybe in the previous page, where it asks about goods or services. So like your business, say, if you had a media company or a marketing company, and you wanted to do business with a Japanese company and go into a partnership with them for some event or whatever, this is like an option to help make that work?
It would. We definitely support services. I think a good example is a company here in Portland that I helped arrange financing through Banner Bank, where they're providing educational assessment software, basically for language and for, in this particular case, Middle Eastern languages, to assess what is the, in their case, the level of deterioration in educational performance due to the pandemic, and especially for those immigrants going out of Syria into Jordan. So I bet it can apply in a multitude of ways, but services are clearly something we want to be able to support. And your example is a good one. As far as the use of loan proceeds, you definitely need to be able to outline that under whether it's a purchase of fixed assets or if it's being used for permanent working capital, debt refinancing, whatever the case. Export benefits of the loan and the lien position, as I was alluding to a moment ago. And finally, the export attachments, which is primarily the export business plan, or I should say, Yeah, in a sense it is or and. The documentation required for indirect exporters only as far as any documentation from your buyer in country. And here's a quick example of a company that we have supported through the International Trade Loan Program, chemical manufacturer in the Midwest, $20 million in revenues. The international trade loan was used for the full amount of $5 million in addition to a $2.5 million conventional line of credit. Credit considerations in this case, strong historical revenue growth and cash flow, diverse range of products across a diverse customer base, which is very a positive thing as far as lenders and SBA are concerned. A CEO, president has a proven background with similar companies. And then the outcome in this particular case, financing completed, sales grew to $30 million, 90%. SBA guarantee allowed the bank to provide them with a larger conventional loan than they would have otherwise because of our added support. And now, the Export Express program. Again, this is the most streamlined program we offer on the international side of SBA. The banks actually provide it to you without our involvement, which is one of the reasons it can be turned around more readily. I've already addressed the idea of the stair-step guarantee support. Term loan options go up to 10 years in most cases for purchases of equipment or for permanent working capital, and 25-year amortization for real estate. But it can also be used as a revolving credit line, and that you can actually take out for 7 years. It can be then at maturity, can be funded out through a conventional line or a term loan. And as far as the uses or opportunities for use of the Export Express program, again, as a line of credit for transactional working capital or for standby letters of credit if needed, which is essentially like a bond or loan guarantee, but that's typically what U.S. banks make use of instead. And then term loans as permanent working capital, equipment purchases, real estate purchases, or build outs of existing property, debt refinance, and change of ownership. As far as the spatial features of Export Express, it can be used for any export development activity, which is to say it can support export growth using these funds, which in a lot of cases is not going to be revenue, or at least not immediately revenue producing. I mean, we're talking about paying for your travels overseas to meet with distributors in another country, or providing samples of your product, whatever the case might be. It's intended on a essentially non-transactional basis, but to help you build your base of business over time. And then the lender has full delegated authority under this program, which is again why they can turn it around more readily, using their own guidelines and making sure they're following SBA guidelines as well. Export Express loan limits are independent of SBA Express, which is over there on the other side of the 7A program. As for conventional domestic purposes, but you can actually use an Export Express for $500,000 alongside of an SBA Express for up to $500,000, or a total availability of $1 million. And then finally, applicant need only complete an export questionnaire, and I'll show you a quick example of that as opposed to a full business plan. And that's not so legible, so I've put it into larger print in the lineup of questions here stated in the questionnaire, which is to say description of the product and services. You saw that as it related to the export plan, this explanation of how the loan proceeds will enable the business to enter new markets or expand existing ones, list of the countries to which the business plans to export. Again, that's key. We actually evaluate that, and so does the lender in terms of the risk of those countries. Income statement showing the borrower's export sales for the previous 12 months, estimate of what the planned export sales will be for the next 12 months, and then finally to indicate if it's an indirect or direct export. Another example here for SBA loans, SBA Export Express loans, and that is this is a service company in this particular case, software and engineering company in the Midwest. It happens that our new director of trade finance for OIT nationally was from Chicago. He's now in DC. So we have a lot of examples that he came up with for the Midwest. In fact, he was with one of the banks there in Chicago. Annual revenues, $3.9 million, loan program. In this case, they used Export Express for a loan of up to $375,000 as a term loan for working capital and to refinance debt. Credit considerations, international projects led to a need for an increase in accounts receivable, which is to say they had to carry a higher level of receivables, so they needed additional working capital, permanent working capital to do that. And in addition, the previous lender to this company needed to be refinanced. Finally, as far as the outcome, term loan improved cash flow, and allowed the business to pursue additional export markets. All very positive. That's what we're looking for. Export Working Capital Program, EWCP. This gets into a little bit more pure trade finance because it is transactionally driven financing. Export Working Program is used to fulfill export orders. I mean, it's literally when you're at a point where you have orders in hand and you need to finance them. You need to go out against a single transaction, a single contract overseas, or it can be multiple revolving transactions. Your business can then use the EWC loan proceeds to finance the export orders by purchase of inventory, materials, labor, other production costs on a pre-shipment basis, and then carry foreign accounts receivable through to collection on a post-shipment basis. And it also, by arranging for that type of financing, allows you to then offer open account terms to your foreign customers, which puts you in a much more competitive position than you would be otherwise. Say, for example, if you were only offering payment by cash in advance, which is the predominant means of payment for U.S. exporters, at least small business exporters, it can be very limiting, especially when the dollar is as strong as it is, and there's lots of foreign competition out there for our products and services. Some of them might compare or might be as good, but it is hard to say, and you've got to be competitive not only with your product and service and your technology, but also in the terms you offer for purchase. So just be mindful that in utilizing this type of program, and also I highly recommend using export credit insurance through Ex-Im Bank, Export-Import Bank of the U.S., or through private carriers, that gives you a lot more latitude in structuring your sales overseas. It can also cover insurance and freight costs, can cover even the bank fees related to the transaction, so you can roll it all in to the loan. And it's intended to be, and is almost all cases, a self-liquidating loan. This is what the Medicis were doing in the 1400s. We're talking about transactions that carry themselves through to not only collection from the foreign buyer, but then repayment of the loan in the process. And then you can borrow down again against that revolving line of credit. It can be used to issue standby letters of credit for the term of the financing. And we now allow for terms out 2-3 years. It used to be limited to 1, but you can actually put a standby letter of credit in place for 25% of the face value of that standby. So initially you post cash collateral to get it issued, and then turn around potentially and replace it with the transactional assets, with the inventory and receivables that you've acquired and generated through that sale. The two types of financing structures I mentioned earlier, the ABL or asset-based type of line of credit, which is the more conventional route that the lenders typically like to do. We encourage them to consider transaction-based credit lines as well. because it's much more advantageous to a small business that gets a large incremental order and needs a higher level of support than they might currently have available with their existing working capital assets, with the existing amount of inventory or receivables they have on hand. So to give them the added impetus to carry out that foreign transaction, that larger foreign transaction, we're allowing for advances against the face value of the underlying purchase contract or purchase order or letter of credit, whatever the case might be. And advance rates actually go up to 90% of the direct costs incurred in selling those goods or services. So essentially, it covers all of your costs of goods sold. And that's quite an advantage to get 100% financing of your total costs. But it is limited to 90% or the lesser of the cost of goods sold for that transaction. Then ABL is done against a conventional borrowing base type of financing or against a monthly borrowing base certificate that's made up of the receivables. That's why you have to have the AR agent as well and the inventory schedule. And here's an example on the EWCP, and that is, this happens to be a client of mine who I just closed a loan for. Happened to be with Umpqua Bank, and it's a scrap metal recycler here in the Northwest, not far from here in Hillsboro. And they have now revenues close to $64 million, but they have relatively thin margins, I should mention. And it's part of the reasons I need our continued support. But it was a $5 million revolving line of credit, part of a larger $10 million facility from Umpqua Bank. And it's to purchase scrap metal and carry foreign AR to collection. Very basic, but they're out there buying scrap steel from Schnitzer and whoever else that they can acquire it from and then put it into the export market. Credit considerations, they have sales to India, Japan, Korea, Malaysia, and Belgium, and beyond. And we're steadily increasing, and the company needed additional working capital to support that higher level of sales. But they also have rapid cash flow turnover, but relatively thin margins, which keeps them in need of additional working capital beyond what they generate themselves. Outcome, added working capital allowed the business to expand sales and diversify into higher margin shipments of bulk mineral ores, which they're now leading into. I am the Export Finance Manager, as I mentioned, for this territory. I am here to discuss borrower eligibility, to meet with bank clients if they want to have a joint meeting, and to review export business plans as they're being developed, review export express questionnaires if needed, and then finally to underwrite EWCP revolving lines of credit as I did with the company or the transaction I had just referred to. That's my contact information. I'm actually working out of Wilsonville, where my home is, and out of downtown Portland at the World Trade Center. I'm the lone wolf away from the Portland district office, but I get to go over there and see those folks on a regular basis when we get back to the office. And I just want to thank you for attending and open it up to any questions you may have, any additional questions you may have.